At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth, so find out if you qualify at peoplescapitalgroup.com. All right, ladies and gentlemen, welcome back to the Passive Cash Flow Podcast, where we help people invest in real estate. Some episodes include interesting guests that span dozens of different types of industries. Like today, we have Taylor on the show. Other episodes offer analysis of popular topics that pertain to people seeking to learn how to build passive wealth in real estate. So listen in and enjoy our off-the-cuff podcast made to entertain, educate, and help you learn how to create passive wealth in real estate. All right. So today we have Taylor Loht on the show with MT Capital Passive Wealth Strategy Podcast. I had the honor of joining your podcast a few weeks ago. I love the show you put on. We also did a webinar together, which was a great engagement. You really have a good group over there. I like what you're doing. So I want to bring you on our show here and learn about how you got started in real estate, how you're bridging that gap from a general partner. You started as a limited partner, then you moved into being a general partner. We're going to talk about that a little bit, and just how you kind of found that passion for real estate and how to get up and go and create a real estate fund, which I know you're working on as well. So lots of things going on. How are we doing today, Taylor?
Doing great. I want to thank you for having me. Love that introduction and the format of the show is, very near and dear to my heart.
Awesome. Yeah, absolutely. We keep it really off the cuff here. I like to say we're like Joe Rogan, but we get half as many hits. So we're still working on getting to that million mark, but we'll get there. Spotify called me. I didn't call them back. I said, okay, no, I don't. Sure. Yeah. I said, put another zero on it, but yeah, that's how we roll here. But no, man, it's great to have you in the show here. So yeah, I really like how you got started as a limited partner, and then you found the strength and the courage to get into being a general partner. And for our listeners out there, so a limited partner is someone who is a passive investor. They're not generally having voting options. They don't make day-to-day decisions. They're simply investing their capital as a passive investor, enjoying probably updates on their investment, hopefully quarterly checks or a big check at the end of it. And of course, a GP, a general partner, is the opposite of that. That individual is making those day-to-day decisions. I'm a GP. I run People's Capital Group. Seth Martinez is my business partner. He's the other GP. So we're general partners. We're making decisions day-to-day. And so most people are participating in an LP position, a limited partner, a passive investor, but jumping into a GP is a really big difference. So talk to me a little bit. Let's go back to the beginning. What first encouraged you to make the leap as a limited partner, plunk down your hard-earned capital?
That's an interesting question. And I suppose it makes the most sense if I rewind the clock and help the listener understand a little bit more about my thoughts, thought process, and just who I am kind of naturally. And I had this realization the other day that I'd always been thinking and telling people, which is true, that ever since I had two nickels to rub together when I graduated from college and got a big boy job, that I was always looking for ways to turn that into more and get my money working for me. And I read The Intelligent Investor by Benjamin Graham and got into the public markets and all that. But that actually was not when I first got started trying to turn money into more money. Rewind the clock even more. I am old enough to have not only one, had a job at Sears, two, I was back in the era when you could actually make some kind of return or money or get decent amount of interest from a bank by just putting your money in the bank. I'm that old. It feels crazy to say because I'm in my 30s, right? I'm not an old guy, but we don't live in that world anymore. So ever since I was making money, I was trying to turn my money into more money. And in my mid 20s, I was, getting into my career thinking, how can I get to, a financial position that I'd like to be in, right? Earn much more money than a career. The career was taking me. And I read Rich Dad Poor Dad, like so many other real estate investors out there. That's what got me into real estate.
Mm-hmm.
And I was looking for my path. I spent a couple years networking. I was looking at doing an MBA program, took the GMAT and all of that. And then I read Rich Dad Poor Dad, and that changed my trajectory. Got to networking in real estate. Eventually I learned about real estate syndication. And that is just, I was like, that's what I want to do. I don't want to flip houses. I don't want to do burrs. I want to be in real estate syndication. And it's just the scale really speaks to me. We can work with so many others. We don't have to do aspects or parts of the business that are kind of, I don't know, if you will, icky. I don't want to manage the property. I don't want to unclog a toilet. I don't want to.
Oh my gosh, yeah.
Things. We can hire people. So I had capital saved up over years of just living frugally and investing in the market and all of that, and knew I wanted to get into real estate syndication. Went networking. Eventually met a number of syndicators and just went for it with my first LP investment, because you got to get started somewhere. And went into it.
It's funny you tell that story. I remember when I was probably like 12 years old or something, my parents had a condo in Franklin, New Jersey, and we would go there and paint it every time a tenant turned over or something like that. And I would look, it was a big, like 300 complex condo. And I always say, man, I don't know how it's done. I don't know why, but I want to, and I will own one of these one day. And I didn't even know what real estate was back then. I was a kid, I just always had the passion to own apartment buildings. I read Rich Dad Poor Dad as well, did all those things also. And it's kind of incredible though. I think back, that story sparked that memory. And I said, oh, you know what, maybe I guess I am doing the right thing. I know, even as a kid, I dreamed of that. And even when you don't know how, that you want it, and there's a passion there. But that's really cool. And so you found a good general partner through networking, and you found a good deal there through that general partner. And so was it an apartment building the first investment you made?
So it's actually 2 apartment buildings. And as a response to what you said about your experience with your parents, because I had a very, very similar experience before I started, years before I considered becoming a real estate investor. But when I was in my first professional job, which I hated, by the way, it was just the super wrong fit for me, and nothing about the people I was working with, perfectly fine people, fine company, but it was just a wrong fit for me, and I was a wrong fit for it. But I still showed up and still did the work, but I hated it. And one morning I was driving to work and leaving my apartment, townhome, drove past the office that manages big townhome community, and I just happened to see there was an Audi. I remember it as an A8 parked at the office, and I just thought to myself, I remember thinking to myself, I am so sure that's the person who owns this complex. I don't have any data to support that, but it's sure not somebody who lives in this complex. I think that's the owner.
There's no other A8s in the parking lot.
No,
so.
No. And I love cars. I don't own a fancy car. I have a decent car, but I've just always liked cars, especially Audis. They're beautiful cars. And that just stuck with me. So I had a very similar experience to that. But anyway, regarding my first investment, that was 2 apartment complexes acquired by a real estate syndication team. And that deal actually ended up taking a left turn. I learned a very interesting lesson from that deal, if we want to.
Sure. Yeah, tell me the lesson, man. I don't want to hear about your successes. I want to hear about your failures. They're far more interesting for our listeners, and you learn a lot more from them. So let me hear about this left turn. This is pretty interesting.
Yeah, absolutely. So the syndicator who ran that deal, I just want to get a few things out of the way to make sure I'm, disclosing or covering the bases here. The syndicator who ran that deal has been on my show, and we talk about this on my show. And we did end up actually making money on this deal, although not as much as we had expected. And I think the syndicator handled the situation very well, all things considered. So I want to make sure we, cover that I'm not trashing anybody, in that deal.
Understood.
The short version is, we closed on the properties, bought the properties, and then after a few months, the specific timeline I don't recall, but after a few months, the syndicator general partner discovered some irregularities in the financials or the paperwork that led him to the conclusion that the property manager was misbehaving with the finances, if you will. I don't want to use a specific term, but not treating our money in the way that he should have.
Misappropriating funds,
if you will.
Yes.
If you will, yes. And
okay.
That was normally that's just a problem, right? You have to fire the property manager, get things in line, and
I've done that. Yeah.
take care of it, right? I mean,
Yeah.
It's an unfortunate situation, but there's
Mhm.
damage control that you can
Sure.
can.
Mhm.
This was complicated by the fact that the property manager, or the gentleman who owned the property management company,
Mhm.
had general partnership ownership in the deal. So that makes him a lot harder to fire,
Oh, geez.
is the short version.
Right.
That led to legal battle, arbitration, and that gentleman actually ended up taking his own life toward the end of the.
Oh my gosh.
Yeah, it's really, really serious tragedy, right? And
Whoa.
our the general partner, again, I think he handled the situation very well, but it was a long battle, and that is not the only circumstance that I've seen where a property manager having general partnership ownership in a syndication ended up being a big issue, because if they misbehave, they're a lot harder to terminate. It's one thing if the property manager is doing the deal and they're kind of running the whole thing, or if they're a subsidiary of the general partner, then there's still things that can be involved. But if it's like a quasi third party, I've just seen that blow up more often than not.
Yeah, I mean, the management of the real estate is the most important thing. You can maybe, you want to make your money when you buy, but perhaps I've overpaid a little bit for properties in my experience, and that, usually you can make up for it by maybe keeping your costs down, or the market does better, you think, or there's mistakes you can make in real estate that are kind of salvageable. The mismanagement of the property in general, or hiring the wrong management company, firing them, putting in place a new management company, that's the biggest challenge to deal with, right? And it's all about the management, because essentially when you're investing in a piece of real estate, you're investing in a business, a small local business that's going to be run by the property management company. So the most important thing is who's running the building, and that's we recognize too. So I fired a management company that was nationwide. You would know them if I told you them. They just were not doing what they said they were going to do. They're at like 70% collections, and we were like, you promised us 95, and they're like, well, it's South Jersey for you. We're like, what does that mean? So gosh, really bad opinion of South Jersey they had. So then we hired another. Can you blame them? No, we hired another property management company, and they actually ended up stealing money from us. It was a small mom and pop company, and we had a lot of challenges with them. We took them to small claims court, and we won the case. And we were one of the first companies to be paid out of this fund that was created for real estate, real estate people that are stealing funds from others in the real estate industry, or getting to suit in those cases and losing. So the fund was there to kind of pay out to individuals like or companies like ours, because what happens when you win a civil case is you may have won the case, you may have got the judgment, then you have to collect. And chances are, if they're a scrupulous individual that put you in that place in the first place, then they're not going to pay out, and you're gonna have to chase them in court after court after court. So instead, this fund was able to pay out to us very quickly. So anyway, overall, it was a good experience. We learned a lot from it. It forced us to develop our own property management company around 2015. We were around 50 doors or so then, so we had just enough to kind of make sense of it financially. Although for years it's been a loss leader. Still to this day, the management of the real estate actually costs a little bit more than we charge, so that it's not a profit center for us. We make our profit through acquisition fees and ownership of real estate primarily. So we need to perform to get paid, right? We need to close on the deal. We need to make a cash flow, get our refinance mark done, to pay ourselves and eat ourselves. So it's a nice win-win structure. But boy, that management company has been a competitive edge. It's allowed us to have much better control of our assets. It's a lot different when the company that is the people you hire, they're your employees, as opposed to a third-party company, or there's like one GP who kind of like is all in charge of that, and the other GPs are kind of not in on it, like, which was your situation there. For us, like, the GP is the management, and it's all one. So we want to make sure that, of course, not only are we transparent, but we also have a separation of powers. We have a whole third-party bookkeeping firm, accounting firm that does all of our bookkeeping, all of our tax prep. So there's multiple different eyes on the situation. There's separation of powers, and there is a third-party accounting firm that oversees everything as well. That's not affiliated with People's Capital Group. So nice separation of powers there to make sure everything's above board. But man, that's a crazy story, and it's a sad story with the suicide in there as well. Obviously, I don't want to get too much into that, but that is not a reason.
No, it's a tragedy. I mean, the only thing is, the money aside, I don't know. I don't want to say, I'm sure he had, a family that was affected by that, and my heart goes out to them, because there's more to life than money, of course. And I think if we were in a down market, at the time that the macroeconomic, the fundamentals were in our favor, I'm not sure we would have made money on that deal, frankly. I think we were really helped out by the market for, many, many reasons, but
sure,
really good learning opportunity. And like what you did at your company, many syndicators, general partners have brought their property management in-house. Not all, and I think there are pros and cons to both, but
there are.
It seems like for many teams, they've determined that was a smart move. So
it just made me nervous thinking, okay, here I am putting my reputation on the line, raising all this capital, because I'm in the fundraising space. So I'm out there doing these podcasts and webinars and speaking on stage. My reputation is everything. So it's the model of syndication is you raise the capital, you put your name on the line, and then you hire a third-party management company to manage everything from A to Z. And I get that. The benefit of that is it opens up many markets, and now you can invest in all different types of states and all different types of markets, and that is nice. And I get that. The limitation of our in-house management company is that, geographically, we can only go so far from Berkeley Heights, New Jersey. Now, we happen to love this market here in North Jersey. We know it very well. We have our boots on the ground, our great realtors and wholesalers and contractors, and it's taken years to get to where we are. We know landlords that bring us deals. So, it just, this experience of building this whole network and infrastructure here, I can't imagine starting fresh in another market. In fact, the webinar I did with you was about starting fresh in another market and how hard that was. And it was almost like, realizing what you have when you already have your infrastructure in place. So that really reminded me when I went and started in a fresh market. Even though we had a lot of the resources of People's Capital Group behind us, it was still the boots on the ground, the people that do the day-to-day work, are so important. And those relationships are so important. All those independent contractors, that not having that book of business is just so such a weak point that it was so hard to get started in a new market. But yeah, so I really, so at that point, you invested as a LP in a deal. It wasn't perfect. You had your challenges. You learned a lot from it. And then you became a general partner on a deal. Is that correct?
Yeah, that's right. And we ended up selling that property last year in 2021. But yeah, we bought it in 2019 and, rode through COVID. And that was the experience of, being on the phone with the property manager every week, and especially it was a C-class property. So, that has its own challenges. The experience of talking with the property manager, the boots on the ground, the gals in the office, really just drove home the importance of those people in this business, right? Because they're the ones that have the relationships with the tenants, and they are really impacting the tenants' willingness to, work with us to get take advantage or of those various, rent relief programs that were made available through COVID during the eviction moratorium. And that really helped us keep the collections up because, I don't know about you or the listeners out there, but when the eviction moratorium was announced and, hey, nobody has to pay rent anymore, I was freaked out. Before that money was available, I mean, these bills have to get paid. People in the office still want to get paid. Plumbers still want to get paid. Everybody in your business that maintains the property and all of that still needs to get paid, before we can make a return. So that was a big concern, right? But I think the make or break for us in that deal and a lot of others out there came down to the people in the office who were working with our tenants to help them through those programs.
Yeah, what a crazy time, right? 2 years ago, pretty much. Almost, right? And I wonder if history will look back on that time and say, what an injustice to the Constitution of the United States of America. I mean, private property rights is literally one of the cornerstones of America. And the idea that we're free from the government, free from tyranny, free from the King of England, and it's like that's history 101 here, people, and for the CDC, not even like the government, the CDC now it decides what all landlords can do. Like the amount of power they had all of a sudden was incredible and
really crazy.
I just can't believe it. And still with everything, the amount of power, and still the fear that they instilled in our society to be able to just take your freedoms away so quickly. I mean, in the matter of a week, we went from being small business owners that owns, $20 million in assets to, are these really assets? Because if I can't collect rent on them, then what are they worth? They completely changed the game. Now, luckily, we were able to work with our tenants, and most of them were cooperative and did pay rent. The ones that got COVID or lost their job or ran into hardships, we connected with government resources and nonprofit companies to help them, get paid out there. And those resources did come through in time, and we were able to actually do pretty well collections overall and get a lot of those back due rents were paid up in full. So I think at our worst month, we were at 87% collections. Now we're back up to our usual 97, 98. And but it was a scary time. I think, honestly, I probably have a little bit of like PTSD from it or something, looking back on that. I mean, we were so scared. The media was saying, 2 million people were going to die. If you get this, you're going to die, and we figure out as time goes on, well, actually, the majority of the people that are dying are over the median age of death, meaning they were literally at that point where they're older than the average age we die at. And that's where the majority of the people were dying. So if we really knew that off the bat, it was, well, maybe we shouldn't shut down the whole economy, shut down the whole place. You can not pay rent. That's fine. But of course we didn't know at that time. And even as the data came out, though, the rules didn't change. I think just recently have a lot of the mandates been lifted and the mask rules been lifted. So it's crazy. I don't know if you could tell which, how I feel about the whole thing.
Well, I certainly can, but there's a lot there, right? Regarding all the shutdowns that happen. I mean, given the knowledge that what we didn't know at the time, I think that was a lot of that was probably the right move, because if you don't know how bad it is, but it also looks bad, then it's better to overshoot in terms of a quarantine and the trying to keep it contained, right? Because if we don't know, we have to be super careful. But it was only a couple of months till I was personally, back out at jujitsu. But, regarding the eviction moratoriums and all of that and the shutdown of the economy, we're really bearing the cost for that now, because what the Fed really, what the government decided to do when we shut down the economy was to fire up the money printer, devalue the money. And that's always going to cause inflation, right? They handed out a bunch of money to Wall Street, to people, to a lot of us, right? From the paycheck protection program to all the, QE that they did to, just sending people checks, is that just devalues the dollar, right? And we're going to be seeing that cost, here over the next, who knows how long, right? It's hard to predict that, but everybody's asking about the next crash of XYZ, and really strong inflation like we're seeing now is a crash in the value of the dollar. And I think that's something that we as investors or people in general, we might not think about that in those terms, that inflation is a crash in the value of the dollar, or at least a significant inflation, right? They target, 2% or whatever the Fed does. But when we see what we're seeing now, that's just the dollar falling apart. We saw that after Nixon closed the gold window and effectively defaulted on the country's debt. Markets kind of really went up fast, and it's because the value of the dollar went down really fast, right? And we're seeing something very similar now. Now, whether Jerome Powell is, Paul Volcker in, 2022,
Sure.
I don't think so. I don't think he's going to do a Volcker, but I also don't know, right? We can only deal with the cards that were dealt.
Yeah, of course. I think the Fed has been irresponsible in tapering. I think they've been way too gentle on that. Yeah, on the whole situation. I think they printed way too much money, and but that's a whole other podcast. But yeah, absolutely.
Mm-hmm.
It is a shame, there wasn't enough forethought at the time to think, okay, if we just shut everything down and just hand everyone a check. First of all, it messed with the whole American concept that we work for our money. When we got that PPP payout, I was like, what? I mean, where'd this money come from? And then the other checks that everyone was getting, I mean, it was a weird mindset. And I still think I have friends and siblings that are kind of stuck in that mindset of like, well, money's not real because everything's shut down. I just got a check in the mail, or just move back home, or and it did kind of indicate to all of us like, yeah, it's just like we control you completely. We're the government. We tell you when to go to work, what to do. We're going to tell you to sit home, shut up, and we're going to pay you to do that. But by the way, it's your money we're borrowing, to do that. So, don't look here, don't look here. Celebrities, look at Will Smith. He slapped a guy. Will Smith, so it's amazing how the media gets us to turn our heads to these shiny things while literally the feds are stealing money from us. If you have your money in a savings account, like a lot of, unfortunately, people, for the first half of the wealth of America, right? Most people keep their money in a savings account, right?
Mm-hmm.
The poor to moderate income individuals keep their money in a savings account. The stock market and real estate investments on the scale that we do it are really for the accredited or sophisticated investors, more wealthy individuals, upper middle class options. So unfortunately, if you're in middle class or lower middle class or the poverty line, these crazy low interest rates of the savings banks are just taking money from the people that need it the most. And so inequality has grown from this. It's been really an interesting experiment. And I think we're still figuring out the ramifications of it. Bottom line is own real estate though, right? Because the real estate's going up. Don't pay too much for it. Be smart when you buy it. Manage it well. But I my crystal ball for real estate values, and I'll ask you about your crystal ball in a second, says that we have so much demand. And they're just not making enough housing to keep up with the demand, at least here in North Jersey. And I know a lot of other densely populated states as well are seeing this, that boy, even if like the demand ticks down, a fair amount from the raising interest rates and just weary inflation, lack of consumer demand, it's still, the demand is so strong and the supply is so small that it's going to take a really large correction for things to go the other way. I think prices are just going to stop growing so quickly. We're going to reach a wall. But then again, my partner is very bullish on inflation, saying, inflation is going to keep on boosting values up. And all indications say, well, yeah, inflation, one of the biggest effects is real estate values. We see that continue to grow. So real estate is a good hedge against inflation as the cost of our debt lowers and the value of our building higher. Again, raises. It's a really nice combination for us landlords and property owners. But what does your crystal ball say about the future real estate markets?
So that's a very complicated question, and I'll go through a few of my thoughts. So you mentioned about housing shortages in most markets, which is definitely true. In the lion's share of, say, major cities out there, there's just not enough housing for the demand, especially over the next, say, 5 to 10 years. We can kind of see what's going to be built, and there are going to be more people / families than there will be places for them to live in most areas, which is a big problem. And that supply demand imbalance does tend to push prices upward. But another, counterpoint to that is interest rates are going up very, very fast, especially on debt. And that, I don't think we're headed toward another great recession. I think that was kind of a black swan event. There were a lot of things that had to happen, but by my estimation, by my read of the situation, the Great Recession was not caused by, say, a massive oversupply of real estate. It's not that every city out there hugely overbuilt. We had a huge oversupply of real estate and there was just too much housing and the demand fell off. Really, what happened is interest rates went up. Wall Street wasn't ready for that to happen because of, a lot of fraud and other things that happened out there, right? And that caused a crash in the capital markets. So the capital markets are really, and to my estimation, what caused the Great Recession. It was less a real estate thing and more a capital markets thing. And
subprime lending and then
subprime lending and everything happening with, all the securitized debt that I'm certainly not an expert on, but I try to understand. And I think the question is, can a disruption of the capital markets happen again? Of course, that happens every 10 years or so, if you, give or take. So another aspect here is, so I have my investor hat on, but I also have my person who lives in the world hat on. Right. And my fiance and I own the home where we live now, but we want to upgrade. We want a little more space. We want, bigger yard and all those kinds of things, more amenities, live in a different part of town, blah, blah, blah. So we've been shopping for the last 4 months or so, maybe 5 months. And I've been keeping an eye on the market, but we didn't get serious until this year in 2022. We live in Richmond, Virginia. I don't know if you mentioned that earlier. And we're getting a lot of transplants from up in Jersey and Northern Virginia and all that. The housing market, single family housing market, is an absolute wreck. We're putting in, we've stopped because of how awful it is. I'm just not going to spend my time on it. We're going to stay where we are and worry about it later. And once things kind of calm down, but the market is insane. People are offering way over asking price. And as interest rates go up, it seems to be, by my observation, people are just getting more desperate. And again, this insane single family housing market is going to force more renters to remain renters. It's going to prevent people from going from being renters to going to being homeowners, which is a big, I think that puts upward pressure on rents pretty significantly. So there are a lot of things to consider. I think I am expecting inflation to continue a little while longer, but really tail off depending on how aggressive the Fed gets with interest rates. I mean, we just kind of are where we are with those. I think the increasing interest rates for the next year or so, if they stick on the path that they're projecting, I think that's going to cause some kind of problems out there. It almost has to. Plus, they're doing quantitative tightening. They're going to start reducing their balance sheet.
Yeah, that's important.
Something's got to give. I think there will continue to be opportunities. Real assets like real estate, especially income producing real estate, I think are still a good place to invest if you're doing the right kinds of deals that can deal with economic disruptions. I think it's dangerous to get too bullish on any one asset class, because then you get brazen and you get this mentality like we had before the Great Recession.
Just to clarify though, Bitcoin can never go down. So sure, if you invest in Bitcoin, you're good to go. So
I do own some Bitcoin and other cryptos. I think they're an interesting change the market, but they're also very speculative in my mind. So those are some of my thoughts about it. I think it's still, I think real estate in general, especially income producing real estate in the long run, will remain a great place to invest. In the short run, we need to be prepared for these increasing interest rates and whatever knock-on effect they're going to have on the economy. It's going to happen. I just don't know when or what, but it has to happen.
Yeah. And that's a good analysis, because it is confusing, right? Because I just bought a home myself for my family here, primary residence, and just outside of Flemington, New Jersey. And I snagged it. I mean, I don't know how. I think I got a little lucky. I'm a pretty darn good negotiator also. I kind of came in strong. I put a lot down. I wasn't one of those FHA buyers. I, had my little brag sheet. I've done 250 transactions. I got a $20 million portfolio. Although I have to be careful saying that, because then they'll be like, oh, you could pay whatever you want. But like, that's not how that works. So, but I snagged it. I came in strong, and then I negotiated very hard after the repair inspection, the home inspection, and got a great credit. Ended up getting it for below list price at the end of the day. So I'm not saying I'm a really good real estate investor, but the proof is in the pudding there. So no, that was really good. So I snagged the deal, for good property. A little bit of a needs a little tightening up here and there, but that's how you get a good deal in real estate, right? So. But it was crazy. I mean, I probably put in a few offers before, maybe like 5 or 6 offers. I didn't go too crazy. A lot of properties I'd go to and they'd be like, we have 18 offers. And I'd be like, no, nope. It's not worth it. It's crazy. Some of them, you're hanging off a cliff, other ones like are in the flood zones. One was like this tiny little home on a good lot, but people were paying like as if it were twice the size of, what it really was. And I got caught up in the hype too. I got excited on some properties too. And I got excited on the cryptocurrency. I bought a Bitcoin at 30, it doubled. Nice. I put in another 30. Now I'm back to 0. So that's where we are in the cryptocurrencies range. So yeah, definitely. It's hard to find gains right now in the market, right? Do you just dump it into an index fund and hope the market keeps going up? Like, that's not really a great bet right now. Do you put it in cryptocurrency and hope, all the hype is right? Like, I don't know. It didn't work out for me. I think real estate, and a lot of people, I know a lot of other people coming to our website saying, listen, I've been in the stock market my whole life. I was told that owning index funds is diversification. 2008 proved otherwise, and I'm ready to now own some apartment, but they make sense to me, right? I'm trying to buy a home. Maybe I live in an apartment, or they own a home. They see how hard it is. So, but yeah, I do agree with you that we're going to face some headwinds. Ultimately, we have to at some point. We need a market that we can get deals in. If the market is this difficult, this much of a seller's market for too long a period, then it's just going to be harder and harder to get deals. So the market is going to cycle at some point back to a buyer's market phase 1. There's 4 phases in the market, as you know: buyer's phase 1, buyer's phase 2, seller's phase 1, seller's phase 2. We are in a seller's phase 2 now. We're at the tip of the iceberg. The only way to go is down here. So I don't see values though, like just dumping out, because, inflation is so strong. Demand is so strong. Yes, values have to stop growing at 8 to 10, 12% a year. It's not sustainable, but, are they probably just going to kind of stagnate downward? That's more my opinion, but who really knows? I think, markets are markets too. You're going to have certain markets that are going to get nailed pretty hard. You're going to have other markets, like, in my opinion, North Jersey is a high demand market, and you're going to keep your demand there and probably keep your values pretty strong. So who knows where we go? I don't think high-end condos is a smart place to be. I don't think office space is particularly smart, or even retail right now, right? And apartment buildings are very tried and true. Buy it for the right price, have value add opportunity in the building, make changes to the building that you can control, that really improve the value in the rent collection, and that's going to be a sure pathway to success. That's what we focus on. But Taylor, I know you have to go pretty soon. I do as well. It's been great chatting with you. How can people learn more about you and your fund and your podcast, which is awesome, by the way? How can they get in touch with you?
Sure. Great. So kind of our landing page for everything about me that you can get to is escapingwallstreet.com, ESCAPING wallstreet.com. That'll take you to everything, whether registering for our monthly webinar. We have another one coming up second Tuesday, every second Tuesday at 8 p.m. Getting our top 6 ways to escape Wall Street and build wealth on Main Street, blog posts, all of that. You did mention about my business. We're actually not doing our own funds. We're raising for other folks' deals, got securities licenses and all of that to get that taken care of. You can also find out more about that, escapingwallstreet.com. Join our investor club, go to that link, fill out the form, schedule a call with me and all that. Check out the podcast, the Passive Wealth Strategy Show. Tell me you heard me here. I'd love to hear some feedback from folks. And if anybody has any questions, I'm I'd say a relatively open book. I want to thank you for having me on the show today. It's fun to be in the interviewee side. I so rarely get to do this part. So
it's always fun talking about yourself. Absolutely. No, it's great. It's great. That's why I do this. I'll just sit here and talk about myself for another 20 minutes after this. I don't even record it. It's just fun. No, good. So no, thank you so much, Taylor. And of course, to our listeners, if you want to learn more about People's Capital Group, enjoy more of our podcast episodes. I think we're almost up to episode 90 now, or check out our educational videos there as well. We do a weekly blog post, a weekly webinar, a weekly podcast, monthly webinars, and we have just tons of content on our website, peoplescapitalgroup.com. So we're in the New Jersey space. So if you want to get into New Jersey apartment buildings, peoplescapitalgroup.com is a great place to go. If you want to look at more of what Taylor has and his deals all throughout the country here, where do you primarily focus?
We're kind of all over Sun Belt, Southwest, some in the Midwest. We work with a number of different syndication groups, and apartments and self-storage are my two favorite asset classes right now.
Cool. So then you can go check out Taylor there at escapingwallstreetcasino.com. Is that correct?
No casino, just escapingwallstreet.com. Although maybe I should go buy that other domain. Not that expensive.
The casino known as Wall Street. I love when you say that as your introduction to your podcast. That's a great line.
Thanks.
Very cool. All right, listeners, thanks for joining us on another episode of the Passive Cash Flow Podcast. Hit subscribe and check out our other content. Enjoy your day.